This morning, I'm joined by Chad Latta, the Vice President of Farmers and Merchants Bank in Piedmont. He's here to discuss financial planning. Good morning, Chad.
Good morning. How are you?
I'm doing well. It's been a long time since we've seen each other.
It has. Been way too long, but it's always good to see you.
It has been. Well, this morning we're going to talk about financial planning. And with so many financial institutions out there, let's talk about the difference between a bank and a credit union.
Okay. Banks and credit unions are basically the same, as in you can deposit money, withdraw money, and get loans. The main difference being a credit union is more of a non-tax paying subsidy that's geared more toward a certain clientele. I say, like, teachers, union workers, etc. Your banks are more of a true tax paying corporation that is more run by stockholders and a group of people, and can basically go toward any kind of clientele.
Okay. Well, we've got over 4,000 employees on the property. Many of them are teaching their children and their grandchildren how to save. Are there any accounts out there that are geared toward children?
There are. They're your traditional savings accounts, which for kids we call them piggy bank savings accounts. You can just basically deposit money and it earns a certain little interest rate. And that's a good way to do it, because you can also control what you put in and take out. Because you're over the minor. Another good way is just getting your kids a piggy bank. Kids love to see that money. It gives them something to put it in. They love doing it, and it kind of they can see their money. Kind of teaches them that way. Just teaches them good spending habits. That's basically.
And that's probably a good way to get them in the habit of saving. If they
Exactly.
can hear that little jingle.
Exactly. They love it.
And of course, those jingles we hope turn into paper money soon.
That's right.
So is there any appropriate age to start saving?
Not really. I mean, it's never too early. The earlier, the better. Naturally, the any kind of the longer you have to save, the more you're going to save. So really, the earlier, the better. But there's no really age, I would say.
Okay. Well, let's talk about the difference between an IRA, a CD, and a savings bond. Okay, so what are the advantages of each?
CDs and IRAs are basically the same too, and they're both FDIC insured. And what FDIC insurance means is you need to make sure that your lending institution is federally deposited insurance governed. So that means that your money's safe up to $250,000. So they're both, guaranteed by the government. The only difference is the tax structure. With a CD, you are, it grows at a higher rate, and your rate is locked for a certain amount of time. And there's a fee if you withdraw it early. Whereas with an IRA, you're not taxed on your money when you withdraw it, because you've already been taxed on it before you put it in there.
On the front end?
Yes, on the front end. Yes, ma'am. So, and there's no really penalty if you withdraw it after a certain age. There's an age limit there. And a savings bond, those are more of your lower rate, but they're your safest retirement tool, because they're guaranteed by the government also. And those are more, your savings bond and stuff like that are more better for older people, kind of retirement age, because they're kind of, they're going to need the money, and their money is there's not much risk there. It's low risk, also low reward, whereas your younger people need to concentrate more toward the stocks and bonds and a more aggressive type savings and investment tool.
Okay, so if a person had three-digit figures that they wanted to invest or save, which would you recommend?
There's not really a number. What I like to tell people is that try to, you don't want to be comfortable. Whatever different people earn different amounts and have different money. So it's really a figure. I would just say go with what you're comfortable at right then, and kind of learn what you're doing and kind of get in the routine. The rule of thumb I usually say is try to do 10% of your retirement. To try to put 10% away to retirement each year, maybe like 10% each month to a savings account or something, and kind of just don't touch it. There's a thing called compounded interest, which is you basically your money grows. If you put in $100 a month to your savings account, it'd be $1,200 annually, correct? So let's just say you did $1,200 a month for 30 years. That's 360 months. You would earn at a 0%, it'd be $36,000. But if you say you had a rate of 5%, then that's going to increase it by even more, and you have instead of 36,000, you have like 83,000. So you can see how the interest really compounds. The more you save and you keep putting in there, and you'd be surprised on how fast it grows.
Yes, and I've heard that saying, save 10% of your salary.
That's right.
And I think if you do that on the front end, you probably are not apt to miss it, as if you
you'd
actually.
be surprised how fast the interest adds up. Really helps you out. You're earning interest on interest, basically.
And making your money work for you.
Exactly.
Well, let's talk about maintaining a good credit score.
Okay.
Any tips for staying at the top?
Yeah, credit is useful, in times of, say you want to make big money purchases, like things you normally couldn't afford just to pay cash for, like homes or cars or stuff like that. Maintaining good credit is important for all those kind of things. It's useful in times of emergencies if something comes up. And also, maintaining good credit could also affect your employment. Could also affect housing, stuff like that. The Credit Bureau looks at 3 certain things. They look at your length of your credit history. They look at your outstanding debt that you have out that you're paying down. And they look at your credit that you're using. So tips I would say is to always pay your payments on time, keep your balances low, and apply for credit only when needed. Don't just have stuff out there that you're not using that you don't need. Try to pay off credit cards each month so you're not paying interest. That really helps too. And for an older person, I would say it's more important to keep your balances low. But for a younger person trying to establish credit, it's better to kind of make your payments and kind of build a credit history. So
some good advice.
Yeah.
A lot of people are doing online shopping now. So, of course, the convenience of shopping from their home. So what's the difference? I've heard people say, hey, let's use a credit card, or do we use our debit card?
Yeah.
What's your advice on that?
If you're doing online shopping, I would say definitely use a credit card. Credit cards are more secure, I'd say, because your debit card comes out of your checking account. So identity theft is it's number 1 crime in America right now. So as I think we're going to talk about later, but your debit cards are really, so if somebody was to hack that, they got money, they got access to your money, and it's a whole big process. You have to go, at least at our bank, to get your money back, you have to go file a police report and do all this stuff. And credit cards have stuff in place to kind of help you with your fraud, and if you've been a victim of identity theft and stuff like that. They're generally easier also to close out and all that stuff. If somebody gets money in your account, get your debit card, you have to close out your account and get a new one, change all your bills you may have automatically coming out and stuff like that. So a credit card is really easier for your online shopping.
Well, Chad, I hate to tell you, but I'm still old school. So
there you go. Checks are good, money's good, however you do it. Yeah.
Yes. Well, you mentioned identity theft earlier, and we know that it's real and it can happen. What should members do to protect themselves?
Number 1 thing is I say never give out your personal information to anybody you don't know. Banks will never send you a text, or they'll never, send you these phony text messages that you get saying your account's been locked, call this number and all that stuff. Basically, if you feel unsafe, always, if you get a message like that, just call. Always call the bank, Never just assume that it's real. Always call to verify first if you don't feel safe. They may send you an email because you're bigger banks. There's a lot of customers out there. You can't call everybody, so you might get an email. But, excuse me. But like I said, never respond to just the email. Always call back and make sure that it's a valid request. And I would say just to safeguard your accounts, keep a check on it. Always look, and it's also a good idea to probably have some kind of fraud detection service also.
So many scams out there.
So many.
Yeah, so it is good to be alert and be aware of what you're doing. I know we could talk forever on this, but if an employee has a question following today's show, how can they contact you?
You can contact me. I work at Farmers Merchants Bank in Piedmont. We do have branches in Anniston, Center, Oxford, Jacksonville, and Piedmont. As I mentioned, you can go by any of those locations. We have great people willing to help too. But you can reach me. I'm in Piedmont. My phone number is 256-447-9041. My email is Latta, that's CLATTA @f_mbank.com. So that's CLATTA @f-mbank.com. And that's basically, I'm one of those weird people that doesn't have Facebook or Instagram, any of that. But that's how you can reach me.
I wouldn't call that weird. I'd call that being cautious.
Yes. That's right.
Well, Chad, we thank you so much for joining us this moment.
I enjoyed it. Hope it was useful.
It was. We thank you for helping keep our workforce informed. Thanks again.
All right, thank you.